The current live price for Plug Power is sitting at $3.14 per share as we move through this April 22nd trading session, which represents an intraday slide of approximately 2.5% from the morning's open. While a downward move of a few percentage points might seem like standard volatility for a high-beta stock in the green energy space, the underlying reality for investors is significantly more complex than a simple red candle on a chart. If you were watching the tickers for Nvidia stock or Apple stock today, you might see a different kind of momentum. But in the world of hydrogen, the tension between what investors expect and what the balance sheet actually shows is reaching a boiling point. The common narrative around Plug Power for the last several years has been one of perpetual potential, a story of a company that is always just one major contract away from turning the corner. But today, the insight that many are missing is that the market is no longer pricing Plug Power based on those grand visions of a hydrogen-powered future. It is pricing it based on a cold, hard liquidity clock. We often talk about the expectation versus reality gap in high-growth tech, but with Plug Power, the gap has become a canyon. Most retail investors using a Fidelity brokerage or a Robinhood app to trade these shares are still looking at the massive 275-megawatt Gen Eco electrolyzer contract win in Canada as a sign of unstoppable momentum. That is the expectation. The reality, however, is that while these contracts are visually impressive, they come with massive execution risks and long lead times that don't immediately solve the company's primary problem, which is its cash burn. When you see institutional activity in the options market, like the surge in call volume we've observed recently, it's easy to think the big players are turning bullish. But a deeper look at the put-call ratio, which currently sits at a very optimistic 0.21, suggests that while some are betting on a bounce, the professional desk traders at places like Interactive Brokers are likely using these positions to hedge against the extreme volatility that has defined the stock's 52-week range of 0.69 to 458. The trading volume today has been significant, yet the price action remains heavy. This suggests that for every investor trying to buy the dip on their SoFi active investing platform, there is an institutional seller or a short seller happy to provide that liquidity. We are seeing a tug-of-war between the Project Quantum Leap narrative, management's plan to reach full profitability by 2028, and the immediate pressure of maintaining operations without further diluting shareholders. This is where the curiosity loop really tightens. Everyone knows Plug Power needs to stop buying expensive third-party hydrogen and start producing its own, which they are finally doing at plants in Georgia and Tennessee. The surprise for many will be whether the cost savings from in-house production can outpace the rising costs of capital and the high interest rates that continue to squeeze small-cap energy players. When you compare the behavior of Plug Power to something like Tesla stock, you see the difference between a company that has crossed the valley of death into self-sustaining cash flow and one that is still building the bridge. Investors are increasingly looking for investment help to navigate this sector because the old rules of buy and hold green energy have been punished. If you're managing an individual brokerage account or using Schwab Intelligent Portfolios, you've likely noticed that the weightings for pure-play hydrogen have shifted as the market demands actual earnings over theoretical total addressable markets. The sentiment is shifting from when will hydrogen happen to will Plug Power be the one to profit when it does. Let's get real about the numbers for a second. The company is aiming for positive EBITDA by the end of this year. That is a massive mountain to climb. They've spent 25 years without a full-year profit. The expectation is that the transition to being an internal producer of fuel will cut costs by 2/3. If that reality hits, the stock at $3.14 will look like a generational steal. If it doesn't, the dilution risk remains the elephant in the room. I want to hear your take on this. Comment below how many shares of Plug Power you currently hold, or if you've moved your capital into more stable assets like Fidelity ETFs, or perhaps even shifted toward crypto on a Robinhood app instead. The business model of Plug Power is essentially a vertical integration play. They aren't just making the fuel cells, they are trying to own the entire ecosystem, from the electrolyzers that create the hydrogen to the storage, the transport, and the final power delivery. It's a bold strategy that requires immense capital. Historically, the company has funded this by issuing more shares, which is why long-term holders have felt the pain of dilution. Recent reports show they are trying to automate assembly lines and use robotic systems to lower manufacturing costs, which is a page right out of the playbook of much larger industrial giants. This is a shift from being a lab-scale innovator to a mass production manufacturer. When we look at the broader macroeconomic pressures, it's clear that the hydrogen sector is currently out of favor compared to AI-driven sectors, where you find Nvidia stock or even the diversifying tech plays like Apple stock. However, for those engaged in online investing, the contrarian view is often where the most significant gains are found. If you are using an intelligent portfolio or a robo-advisor, you might be shielded from this volatility. But for the self-investing crowd on platforms like Interactive Brokers or the Robinhood trading platform, the daily swings of 5% or 10% in Plug Power are either a source of stress or a source of opportunity. The institutional ownership currently sits around 43%, which is relatively high for a company with such a volatile track record. This tells us that despite the skepticism, big money hasn't completely abandoned the ship. They are likely playing the long game, waiting for the results of Project Quantum Leap to manifest in the quarterly earnings. But the retail side is where the real drama happens. On investing sites and forums, the debate is fierce. One side sees a future leader in a multi-billion-dollar green ammonia and hydrogen market. The other sees a company that will continue to burn through cash until it's forced into a corner. Looking ahead, the catalysts for Plug Power are clear. They need to hit their production targets at the new facilities and prove that their margins are expanding. The 275 megawatt deal in Canada is a massive feather in their cap, but we won't see the full impact of that until 2027 and beyond. The market, however, is forward-looking. If they can show a string of quarters with narrowing losses, the narrative will flip from survival to growth. The risk is that if the broader economy slows down and industrial demand for hydrogen drops, those expensive plants they've built might sit underutilized. As you manage your portfolio, whether it's through Fidelity Wealth Management or a simple Robinhood investments account, it's vital to remember that Plug Power is a high-risk, high-reward play. It does not behave like a utility. It behaves like a pre-profit tech startup with heavy machinery. The tension between the expectation of a green energy boom and the reality of a difficult manufacturing ramp-up is what will define the stock price for the rest of 2026. To wrap this up, the central insight here is that Plug Power's current price of $3.14 reflects a market that is tired of promises but still intrigued by the infrastructure the company has built. We saw a dip today of 2.5%, and while that's a small movement in the grand scheme, it shows that the bulls aren't yet ready to take control. The expectation was that the recent contract wins would provide a permanent floor, but the reality is that the market is still waiting for the proof of profit in the next earnings call. We've moved past the phase where a press release about a new partner can send the stock up 20%. Now, the market wants to see the cash. Whether you're looking for investment help to diversify or you're deep in the weeds of self-investing, keep a close eye on the volume and the institutional flow. The gap between expectation and reality is narrowing, but it hasn't closed yet. If Plug Power can actually execute on its internal production goals, the current skepticism will look like a distant memory. If they stumble, the quantum leap might feel more like a step backward. Stay grounded, stay informed, and always look past the headlines to the actual movement of the capital. The path forward for Plug Power is anything but a straight line. It's a series of high-stakes hurdles, where each success buys them another 6 months of runway, and each failure increases the pressure to find new funding. For those using the Fidelity mobile app or checking their SoFi Invest balances today, the red on the screen is a reminder that the green energy transition is expensive and often unforgiving. But for the investor who understands the interplay between sector momentum and company-specific execution, these are the moments that define a strategy. Expectations for the hydrogen market are still set very high for the end of the decade, with forecasts suggesting a massive expansion in global demand. The reality for Plug Power is that they have to survive the next 24 months to be there when that demand peaks. This is the ultimate test of endurance for both the company and its shareholders. As we close out this analysis, remember that the most important tool you have isn't a specific trading platform or a hot tip. It's the ability to distinguish between the noise of a daily slide and the signal of a long-term structural shift. Plug Power remains the most watched name in its space for a reason, because if they win big. If they don't, they serve as a cautionary tale for the entire sector. Keep your eyes on the data, watch the margins, and never let the excitement of a new contract distract you from the reality of the balance sheet.